Hi, my name is Fan Yang, your Chief Currency Analyst here at ForexMinute.com. You're watching today's Forex video briefing. It is Tuesday, November 4th, and we're at the start of the US session. Let's take a look at the New Zealand US dollar pair, which looks ready for bearish continuation, but is still only flirting with the fresh lows on the year. After the FOMC announced the end of QE last week, the US dollar gained across the board and the Kiwi dollar fell under the duress. It has been consolidating in October but showed some signs of a bearish continuation ahead of the FOMC risk. So this was the first sign of a bearish continuation here after mid-October. You see the break of this speed line. Then ahead of the FOMC risk, we had a vulnerable flag pattern here, and then the hammer came down and we had a second bearish continuation signal here after the FOMC announcement. Okay, now we have a third bearish continuation pattern signal here after the what's called the bearish slingshot signal. So the market crossed back below the moving averages and then treated the moving averages as a resistance, and then we had a very strong bearish candle here. So we had multiple bearish continuation signals coming down here this week. But as we started this week, price, it did continue to fall a bit, and it did crack the previous low on the year at 0.7707, but essentially respected the 0.77 handle as support, and now we are seeing a rebound. Now the 0.7070 to 0.78 area should provide some resistance. We have this falling speed line, and we had these previous support pivots here in that area, but a break above 0.78 would open up near-term upside risk. This would suggest the market is not ready for the bearish continuation, with the non-farm payroll event risk looming on Friday. In this scenario, the one we continue to consolidate, a break above 0.78, we can expect a rally towards the 0.7850, 0.79 area, but we should limit the bullish outlook to 0.79, especially if it's ahead of the, if it's before the non-farm payroll. The overall bias is still bearish. The 4-hour RSI also should hold below 60 as well if the market is indeed still if it still has that bearish bias ahead of the non-farm payroll. Having that bearish bias means that if the non-farm payroll is in line with expectations, the bearish bias would come into play and still pull down the Kiwi dollar based on US dollar strength. However, if price pops up above 0.7950, maybe even before that, we have a break here. Even if it pops up above 0.79, I think the market would start to show some bullish bias heading into the non-farm payroll event risk, in which case, if the non-farm payroll report is in line with expectations, we should expect a bullish correction attempt in the Kiwi US dollar pair, with pressure back towards this 0.8030 area, October high here, and with the potential of breaking higher, which would create a price bottom from this October and early November price action. And that wraps up today's Forex video briefing. Thanks again for watching. Trade safe, trade well.